Welcome to the Tellone Perspective. I'm your host, Dean Tellone. Over the past 50 years, I've had the privilege of helping countless entrepreneurs build their businesses from the ground up. I started my own firm, Tellone Financial Services, back in 1975, and we incorporated in 1986. So I know firsthand the excitement of running your own company. But I also know the anxiety that comes with managing the financial side of it, especially the taxes. Today, we are going to break down the essential tax considerations every small business owner needs to understand. We'll cover how to choose the right business structure, how to handle estimated and payroll taxes without getting penalized, and the common deductions you might be missing. Whether you are just starting out or you've been in business for years, this episode will give you a practical roadmap for navigating the tax landscape. Let's get started. The very first tax decision you make as a business owner is choosing your entity structure. This choice dictates how you pay taxes, how much you owe, and how your personal assets are protected. Let's look at the two most common structures for small businesses, the LLC and the S Corporation. A limited liability company, or LLC, is incredibly popular because it's flexible and provides legal protection for your personal assets. But here is something many new owners don't realize. The IRS doesn't actually recognize an LLC as a tax classification. By default, if you are the only owner of an LLC, the IRS treats you as a disregarded entity. You simply report your business income and expenses on Schedule C of your personal tax return. The catch with a default LLC is the self-employment tax. You are required to pay a 15.3% tax, which covers Social Security and Medicare, on all of your net business earnings. If your business makes $100,000 in profit, you are paying that 15.3% on the entire $100,000. This is where the S Corporation comes in. An S Corp is a specific tax election you make with the IRS. Like an LLC, it is a pass-through entity, meaning the business itself doesn't pay federal income tax. The profits pass through to your personal tax return. But the S Corp has a unique advantage when it comes to that 15.3% self-employment tax. As an S Corp owner, you must pay yourself a reasonable salary for the work you do. You pay standard payroll taxes on that salary. However, any profit remaining in the business after your salary is paid can be taken as a shareholder distribution. And here is the key. Those distributions are not subject to self-employment tax. So, if your business makes $100,000 and you pay yourself a reasonable salary of $60,000, you only pay the 15.3% tax on the $60,000. The remaining $40,000 distribution is exempt from that tax, potentially saving you thousands of dollars a year. The S Corp election isn't right for everyone. It requires running payroll and filing a separate corporate tax return. But once your business reaches a certain level of consistent profit, it is a conversation you absolutely need to have with your tax professional. Once your structure is set, the next major hurdle is cash flow management, specifically paying the government what you owe when you owe it. When you worked a corporate job, your employer automatically withheld taxes from every paycheck. As a business owner, that responsibility falls entirely on you. Let's talk about estimated taxes first. The U.S. tax system is pay-as-you-go. If you expect to owe more than $1,000 in taxes for the year, the IRS requires you to make quarterly estimated tax payments. These are due in April, June, September, and January. A common mistake I see is business owners waiting until April 15th of the following year to pay their tax bill. If you do that, not only will you face a massive, stressful lump sum payment, but the IRS will also hit you with underpayment penalties and interest. To avoid this, you need to calculate your expected liability and pay it quarterly. A good rule of thumb is to set aside 25 to 30% of your net income in a separate savings account specifically for taxes. Now, if you have employees, or if you are running an S-corp and paying yourself a salary, you also have to manage payroll taxes. Payroll taxes include withholding federal and state income taxes from your employees' checks, plus the FICA taxes, Social Security and Medicare. For FICA, the employee pays 7.65%, and you, the employer, must match that with another 7.65%. You are also responsible for federal and state unemployment taxes. You must deposit these withheld funds and your employer matching funds with the IRS on a strict schedule, usually monthly or semi-weekly. Let me be very clear. The IRS takes payroll taxes incredibly seriously. Those withheld funds belong to the government, not your business. Failing to remit payroll taxes can result in severe penalties, and the IRS can hold you personally liable, regardless of your corporate structure. My advice: use a reputable payroll service. It is worth every penny to ensure this is handled correctly. Now for the good news: deductions. The IRS allows you to deduct the ordinary and necessary expenses of running your business, which lowers your taxable income. Let's highlight a few common deductions that small business owners often overlook or misunderstand. First is the home office deduction. If you use a portion of your home exclusively and regularly for business, you can deduct a percentage of your rent or mortgage, utilities, and insurance. The IRS offers a simplified method where you can deduct $5 per square foot of your home office up to 300 square feet. Remember, the space must be used exclusively for business. Working from your dining room table doesn't count. Second is the business vehicle deduction. If you use your personal car for business, you can deduct the expenses. You have two choices: track your actual expenses like gas, repairs, and insurance, and deduct the business percentage, or use the IRS standard mileage rate. For 2026, that rate is 72.5 cents per mile. You must keep a detailed mileage log showing the date, distance, and business purpose of every trip. Third, don't forget about startup costs. If you launched your business this year, the IRS allows you to deduct up to $5,000 in startup expenses, like market research, advertising, and legal fees, right off the bat, provided your total startup costs didn't exceed $50,000. Finally, one of the most powerful deductions available is the Qualified Business Income Deduction, or QBI. This allows eligible pass-through entities like sole proprietorships, LLCs, and S-corps to deduct up to 20% of their qualified business income. It is a complex calculation with income limits and phase-outs, especially for service-based businesses, but it can provide massive tax relief. Running a small business is demanding, and the tax code doesn't make it any easier. But you don't have to navigate it alone. Choosing the right entity structure, staying disciplined with your quarterly and payroll taxes, and meticulously tracking your deductions are the foundational steps to financial success. As an enrolled agent, I spend my days helping business owners optimize these exact areas. My advice is to build a relationship with a qualified tax professional who understands your specific industry and can help you plan proactively rather than just reacting at tax time. Thank you for listening to the Tellone Perspective. I'm Dean Tellone. Keep building, keep planning, and I'll see you in the next episode.